The math no longer works. I need you to understand what I just said. The math no longer works. There are 81 million ounces of silver registered in the COMEX vaults right now, available for delivery, ready to go. That is the entire pool of silver that backs every futures contract traded on the largest precious metals exchange in the world, 81 million ounces. And in recent months, the delivery demand has been hitting 75 to 80 million ounces in a single month. Let me say that again because I need this to sink in. The amount of silver being demanded for physical delivery in 1 month is nearly equal to the total amount of silver available in the entire system. That is not a market functioning normally. That is a market on the edge of breaking. And nobody is talking about it. The financial media is silent. The mainstream analysts are looking the other way. But the data does not lie. The data cannot lie. And when you see what I'm about to show you, you will understand why I believe we are witnessing the most important moment in the silver market in the last 50 years. Before we go any further, I have a question for you. What time is it where you are right now? And where are you watching this from? Drop it in the comments. I want to know if you are watching at 2 a.m. because you cannot sleep thinking about silver. I want to know if you are watching from London or Dubai or New York or Mumbai or Sydney. Tell me in the comments. I read every single one. And if you are new to this channel, this is Finance Currency. We break down the data that the mainstream media refuses to cover. We dig into COMEX delivery reports, CFTC positioning data, and global supply chain disruptions. If you want to understand what is really happening in the precious metals market, hit subscribe right now and hit the notification bell, because what I am about to show you over the next 20 minutes could change how you think about silver forever. Let me set the stage. The COMEX is the primary futures exchange for precious metals in the United States. It is owned by the CME Group. When traders want to buy or sell silver futures, they do it on the COMEX. And the COMEX maintains vaults where physical silver is stored. This silver is categorized into two types: eligible silver and registered silver. Eligible silver is metal that meets COMEX specifications but is not available for delivery against futures contracts. It is just sitting there. Registered silver is the metal that is actually available for delivery. This is the silver that backs the paper contracts. This is the silver that someone can demand when they say, "I want my metal." Right now, registered silver at the COMEX is at 81 million ounces. That sounds like a lot until you understand the context. Because here is where the math breaks. The open interest on COMEX silver futures represents claims on silver, paper claims. And right now, there are approximately 290 to 300 million ounces worth of paper claims outstanding on the COMEX. 300 million ounces of paper claims. 81 million ounces of physical metal available. Do the math. That is a ratio of roughly 3.6 to 1. For every ounce of silver that actually exists in the COMEX registered category, there are 3.6 ounces of paper claims. If more than 27% of contract holders decided to take delivery at the same time, there would not be enough silver to go around. But here is what makes this even more alarming. The delivery demand is not theoretical anymore, it is happening. The COMEX publishes delivery data every month. This data shows how many contracts were delivered, meaning how much physical silver actually changed hands. And the recent delivery numbers are unlike anything we have seen in the history of this exchange. Pull this up on screen. This is the COMEX silver delivery chart going back to 2007. Almost 20 years of data. Look at the bars on the right side of the chart, the most recent months. They are the tallest bars in the entire data set. They dwarf everything that came before. The deliveries in recent months have been hitting 75 to 80 million ounces in a single month. When you have 81 million ounces registered and 80 million ounces being demanded for delivery in 1 month, you are running the system at 100% capacity. There is no buffer. There is no margin for error. 1 month of unexpectedly high demand, and the system fails. And I want you to understand what fails means in this context. It does not mean the COMEX shuts down. It means the COMEX cannot deliver the silver that contract holders are demanding, and when a futures exchange cannot deliver the underlying asset, one of two things happens. Either they settle in cash at a massive premium, which destroys confidence in the paper market, or the price of silver explodes as the remaining physical metal gets bid up by desperate buyers. Both outcomes are catastrophic for anyone short silver. Both outcomes are incredibly bullish for anyone holding physical metal. And this is not speculation. This is math. Simple, undeniable math. Let me put this in perspective with a comparison that will make your jaw drop. The crude oil market is the largest commodity market on Earth, trillions of dollars in volume, and the ratio of paper claims to physical deliverability in crude oil is nowhere near what we see in silver. In silver, we have 3.6 paper claims for every physical ounce. In crude oil, the largest shorts hold about 3 days' worth of production. Silver shorts hold 70 days worth of production. Silver is 20 times more concentrated than crude oil. That is not an exaggeration. That is the CFTC data. I will show you the chart in a moment. But I need you to understand the magnitude of what this means. Silver is the single most vulnerable commodity to a delivery squeeze on the planet. Nothing else comes close. And the squeeze is not coming. The squeeze is here. The data proves it. But that is just the beginning, because what I am about to show you will reveal who is behind this, why the shorts are panicking, and what the delivery data tells us about where silver is headed. Stay with me. Now let me show you why the silver market is structurally broken in a way that no other commodity market is. The CFTC, the Commodity Futures Trading Commission, publishes something called the Bank Participation Report and the Commitments of Traders Report. These reports show how different categories of traders are positioned in the futures markets. And buried in this data is a metric that almost nobody talks about: concentration. Concentration measures how much of the total short or long position is held by the largest traders. And in silver, the concentration is off the charts. Literally, pull this up. This chart shows the short position concentration across every major commodity traded on U.S. exchanges. It is measured in days of world production. In other words, how many days of global production would it take to cover the short positions of the 4 largest traders? Look at the right side. Look at silver. The 4 largest silver short sellers hold positions equivalent to roughly 70 days of global silver production. 70 days. Now look at crude oil, the biggest, most liquid commodity on Earth. The 4 largest shorts in crude oil hold about 3 days of production, 3 days versus 70 days. Silver's short position is more than 20 times more concentrated than crude oil, more than 20 times, and it gets worse. The 8 largest silver shorts hold about 105 days of production. That means 8 traders control short positions that would require over 3 months of total global silver production to cover. Nothing else on this chart comes close. Not wheat, not corn, not natural gas, not gold, nothing. Gold, which people assume is heavily manipulated, has a concentration of about 45 days. Silver is 50% higher than gold. Silver is the most manipulated, most concentrated, most vulnerable commodity on any exchange on the planet. And here's why this matters for the price. When you have extreme concentration, you have extreme fragility. These 8 traders are the only thing standing between silver and a massive price spike. They are the wall, they are the ceiling. They have been capping the silver price for over a decade. But that wall is crumbling. Because those same traders, the 4 largest shorts, have cut their positions by nearly 50% since 2024. Half of their short positions have been closed. Not slowly, not gradually, in a rapid, systematic unwind that tells you they see the same data I am showing you. They know the math is broken. They know the delivery demand is unsustainable. They know that being short silver in this environment is the single most dangerous trade on Earth, and they are getting out. Now let me explain why this reduction is so significant. For years, the short position concentration worked like a self-fulfilling prophecy. Every time silver rallied, the shorts would add to their positions. They would sell more paper silver to cap the price. The bigger the rally, the more they sold. And because they had unlimited capital and no delivery pressure, they could keep doing this indefinitely. They were the casino, and the casino always won. But something changed. The physical market caught up to the paper market. You see, the shorts could suppress the price as long as nobody actually asked for the metal. As long as traders were content to hold paper contracts and roll them over month after month, the shorts never had to worry about delivery. They were selling silver that did not exist, and nobody was calling them on it. But that changed in 2024 and accelerated in 2025 and 2026. The delivery demand exploded. Traders stopped rolling their contracts and started demanding metal. The registered inventory plunged from over 150 million ounces to 81 million ounces. Shanghai's silver inventory dropped to just 8 million ounces. The global physical market tightened in a way that the paper traders could no longer ignore, and suddenly those paper short positions became real liabilities. A paper short is just a bet that the price will go down. You profit when the price falls. But a paper short that gets called for physical delivery in a market where physical metal is scarce becomes something else entirely. It becomes a ticking time bomb. Because if you are short and you get a delivery notice and you do not have the metal, you have to go into the market and buy it at whatever price the market demands. And in a market where 300 million ounces of paper claims are chasing 81 million ounces of physical metal, the price the market demands could be astronomical. That is a short squeeze. That is the mechanics of what happens when paper meets physical in a scarce environment. And the shorts know this. That is why they are cutting. They see the delivery data hitting records. They see the registered inventory at critical lows. They see Shanghai almost completely drained. And they are doing the only rational thing. They are running for the exit before the door slams shut. But here's what makes this even more compelling. They are cutting into strength. The price of silver is up 144% year over year. In a normal market, when price goes up, shorts add to their positions. They think the rally is overdone. They want to profit from a pullback. That is not happening in silver. The price is going up and the shorts are cutting. The price is going up and the concentration is falling. The price is going up and the largest players in the history of this market are reducing their exposure. That is not normal short covering. That is capitulation. That is surrender. That is the smart money telling you they do not want to be on the wrong side of what is coming. And now I am going to show you who I think is behind this, and the evidence is going to shock you. Now I need to talk about something that I have been following for months. And I want to be careful here because the data does not name individual firms, but the delivery data tells a story that is impossible to ignore. I believe JP Morgan has flipped from short to long on silver. Let me explain why I think this and why it matters. JP Morgan has been the dominant player in the silver market for over a decade. In 2020, they paid a $920 million fine for manipulating precious metals markets. That fine was for spoofing, which is placing fake orders to move the price, and then canceling them before they execute. It is market manipulation, and they paid nearly $1 billion for it. For years, JP Morgan was known as the largest short seller in silver. They were the ceiling. Every time silver tried to rally, their positions would increase. They had more capital than anyone else. They had more influence than anyone else. And they used that power to keep silver suppressed. But the delivery data from January 2026 tells a different story. In January, JP Morgan's house account stopped over 3 million ounces of silver for delivery. Stopped means they took delivery. They received physical metal into their vaults, 3 million ounces, in 1 month, at approximately $78 per ounce. Let me tell you what that price represents. $78 was during the January dip, the same dip that scared retail investors, the same dip where social media was full of people saying silver is over, the rally is done, time to sell. While retail was panicking at $78, JP Morgan was on the other side of the trade. They were signing delivery notices, they were taking physical metal, they were accumulating. You do not take delivery of 3 million ounces at $78 if you think the price is going down. You take delivery because you believe the price is going significantly higher and you want to own the metal before it gets there. And remember, this is the same firm that paid $920 million for manipulating silver prices. The same firm that spent years as the biggest short seller. The same firm that was the ceiling. Now they are taking delivery of physical metal at crash prices. That is not a hedge. That is not a routine trade. That is a fundamental shift in positioning that tells you everything you need to know about where JP Morgan thinks silver is going. There is a saying I think about constantly when I analyze these markets. The house always wins. In the silver market, JP Morgan has been the house for over a decade. They were the casino. They set the rules. They collected the profits. If the house is now switching from short to long, from selling to buying, from suppressing to accumulating, that is the loudest signal the silver market can send. The house knows the casino is about to pay out, and they want to be on the winning side when it does. But this is not just about JP Morgan. The entire commercial category in the CFTC data is reducing shorts. This is not one bank making a trade. This is a coordinated unwind across the entire banking sector. Multiple large commercial traders are all moving in the same direction at the same time, reducing short exposure, taking physical delivery, positioning for what comes next. When one bank does it, you can call it a trade. When the entire commercial sector does it at the same time, you call it a regime change. I have been covering the COMEX delivery data for weeks now on this channel. Bank of America taking hundreds of millions in gold deliveries. JP Morgan stopping contracts consistently. The banks are not fighting the rally anymore. They are joining it, and the timing of this shift is critical. The banks started cutting their shorts in 2024. That was when the delivery data started showing stress. That was when the registered inventory started its decline. That was when Shanghai began draining. The banks saw the physical tightness before anyone else. They have access to data and information that retail investors do not have. They see the flows, they see the orders, they see the delivery notices before they become public, and they acted on what they saw. They started cutting. They started accumulating. They started preparing for a world where silver prices are much, much higher. Meanwhile, what was retail doing? Retail was selling the dips. Retail was panicking at $78. Retail was listening to social media influencers who said the rally was over. The banks were doing the opposite. Every dip that shook out retail was an opportunity for the banks to accumulate more metal at lower prices. They were not panicking. They were buying. This is the information asymmetry that I try to expose on this channel. The big players see things before the small players. They act before the small players. And by the time the small players understand what is happening, the big players have already positioned themselves. Right now, the big players are telling you exactly what they think about silver, not through press releases, not through analyst reports, through their actions, through the delivery data, through the positioning data. They are getting long. They are taking delivery. They are abandoning the short side. And they are doing it while silver is still under $90. What do you think happens when retail finally understands what is happening? What do you think happens when the mainstream media finally covers this story? What do you think happens when the remaining shorts are forced to cover? The price goes vertical. That is what happens. Now, I need to expand this beyond the COMEX because the silver shortage is not just an American phenomenon. It is global. And the data from other major exchanges confirms everything I have been showing you. Let me talk about Shanghai. The Shanghai Futures Exchange, the SHFE, is the primary silver exchange in Asia. China is the largest consumer of industrial silver on the planet. Solar panels, electronics, EVs, batteries. All of them require silver. And China's exchange is where a huge portion of global silver demand is priced. The SHFE silver inventory is down to approximately 8 million ounces. 8 million ounces. For the largest industrial consumer of silver on Earth, let me put that in context. The COMEX has 81 million ounces and is under stress. Shanghai has 8 million ounces. That is not stress. That is a crisis. When you combine COMEX and Shanghai, the two largest silver exchanges in the world, you have about 89 million ounces of available silver. That is the global pool backing all the paper contracts, all the futures trades, all the options positions on both exchanges. 89 million ounces. Global silver production is approximately 800 million ounces per year. But global silver demand is now over 1.2 billion ounces per year. The silver market has been in a structural deficit for 4 consecutive years. More silver is being consumed than is being produced. And where does the extra silver come from? Inventories, exchange inventories, private vaults, recycled material. But the inventories are draining. The COMEX is down from 150 million ounces to 81 million ounces. Shanghai is at 8 million ounces. The London Bullion Market Association vaults have been declining. The Silver Institute reports that global above-ground stocks are at multi-decade lows. The buffer is disappearing. And demand is not slowing down. It is accelerating. Let me talk about why demand is accelerating because this is critical for understanding where we are headed. Solar panels. The world is in the middle of the largest solar build-out in history. China alone is installing more solar capacity than the entire world combined was installing a few years ago. And every solar panel requires silver. Silver is the most conductive metal on Earth. It is irreplaceable in high-efficiency solar cells. The solar industry consumed approximately 140 million ounces of silver in 2023. That number is projected to reach 200 million ounces by 2027. In 4 years, solar demand alone will consume 25% of total global silver production. Electric vehicles. Every EV uses more silver than a traditional combustion engine vehicle. Silver is in the batteries, silver is in the electronics, silver is in the charging infrastructure. As EV adoption accelerates, silver demand from automotive is climbing. 5G infrastructure. The rollout of 5G networks requires silver in antennas, switches, and circuit boards. Every tower, every handset, every piece of 5G equipment contains silver. Medical applications. Silver is antibacterial. It is used in wound dressings, medical devices, and hospital equipment. Post-pandemic investment in healthcare infrastructure is driving silver demand higher. And then there is investment demand. Silver is money. For 5,000 years, silver has been used as a store of value. As inflation persists and currencies debase, more people are turning to silver as a hedge against monetary madness. Add all of this together and you have a demand picture that is overwhelming supply. The deficit is not going away, it is getting worse. Now let me connect this back to the COMEX math. When you have a structural deficit, the only way to meet demand is by draining inventories. But the inventories are finite. They cannot drain forever. At some point, the physical metal runs out. We are approaching that point. 81 million ounces at the COMEX. 80 million ounces being demanded for delivery in a single month. That is 99% of registered inventory being demanded in 30 days. What happens when the demand hits 82 million? What happens when the demand hits 90 million? What happens when more delivery notices are issued than there is metal to deliver? The system breaks. And let me be clear about what breaks means. It does not mean silver disappears. It means the price mechanism that has been suppressing silver for years stops working. It means the paper market loses control to the physical market. It means price discovery shifts from Chicago to Shanghai, from paper to physical, from manipulated to real. And Shanghai is already telling you what real price discovery looks like. Shanghai premiums over COMEX have been persistent. Metal is flowing from west to east because the price in Shanghai is higher than the price in Chicago. The arbitrage is pulling silver out of Western vaults and into Asian hands. This is a shift in power. For decades, the COMEX set the global silver price, the biggest futures market, the most volume, the most open interest. But COMEX open interest has collapsed 60% to 2013 levels. Volume is declining. The paper market is shrinking while the physical market is tightening. Price discovery is moving east. And the eastern markets price silver based on how much metal is actually available, not how many paper contracts are trading. When price discovery fully shifts to physical markets, the suppression ends. The true supply-demand balance is revealed, and a commodity that has been in deficit for 4 years, with inventories at critical lows, and industrial demand accelerating, does not stay at $85. It goes much, much higher. Now let me show you where the technical analysis says silver is headed, because the charts confirm everything the fundamental data is telling you. Pull this chart up on screen. This is the silver 4-hour chart, EXIG USD, from October 2025 to present. What you are looking at is one of the cleanest ascending trendline patterns I have ever seen in any market. Since October, silver has been making higher lows. Every major pullback has found support on the same rising trend line. The trend line has been tested 4 times, and 4 times it has held. This is the most important line on the silver chart right now. As long as price stays above this trend line, the bull market structure is intact. Every test of this line has been a buying opportunity, and the measured target from this ascending channel points to one level, $128. That is above the all-time high of $121. The chart is telling you that silver is building a base for a move that will take it to new record highs. But here's what makes this technical setup so powerful when you combine it with everything else I have shown you today. The shorts are closing, the deliveries are at records, the inventories are at critical lows. The banks are taking delivery, the structural deficit is worsening, the industrial demand is accelerating, and the trend line is holding. This is convergence, multiple independent data sources all pointing in the same direction. The fundamentals are bullish. The positioning is bullish. The technicals are bullish. I cannot find a single data point that contradicts the thesis. And in a market where the shorts are covering, every move higher forces more covering. Every short that closes has to buy silver to close their position. That buying pushes price higher. The higher price forces more shorts to close. More shorts closing means more buying. This is the feedback loop of a short squeeze. And once it starts, it feeds on itself until the shorts are gone. Now, I need to give you the honest perspective on risk because I do not want you to think this is a guaranteed trade. Silver is volatile. It can move 5% in a day. The dollar is still strong, and a dollar surge can push silver down in the short term. The war in the Middle East creates uncertainty that can move markets in unpredictable ways. Monday could gap up, or Monday could get crushed. I do not pretend to know the short-term direction. What I am telling you is that the structural setup underneath the short-term noise is the most bullish it has ever been. The math is broken. The shorts know it. The banks know it. The delivery data proves it. The question is not whether silver breaks out. The question is when. And let me share something I think about constantly when analyzing these markets. In a short squeeze environment, the price can move in ways that seem irrational. Silver could go from $85 to $100 in a week. It could spike to $120 and come back to $95 the next day. Squeeze mechanics are violent. They are emotional. They shake out everyone who is trading on fear instead of conviction. The people who win in a short squeeze are not the people who time the bottom perfectly. They are the people who understood the setup before it happened, who positioned accordingly, who held physical metal that could not be margin called, who did not panic when the daily candle went red, who understood that a squeeze unfolds over weeks and months, not hours. That is the mindset this data demands. Let me summarize everything I have shown you today. COMEX registered silver is at 81 million ounces. Recent monthly delivery demand has hit 75 to 80 million ounces. The system is running at 99% capacity with no buffer. Paper claims total approximately 300 million ounces against 81 million physical. That is a 3.6 to 1 ratio. If more than 27% stand for delivery, the metal runs out. The 4 largest silver shorts hold positions equivalent to 70 days of global production, 20 times more concentrated than crude oil, the most extreme concentration of any major commodity. Those same shorts have cut nearly 50% of their positions since 2024. They are running for the exit while the price is rallying 144% year over year. JP Morgan took delivery of 3 million ounces in January at $78 while retail was panicking. The manipulator became the accumulator. Shanghai inventory is down to 8 million ounces. The global silver market has been in deficit for 4 consecutive years. Solar demand is exploding. Industrial consumption is overwhelming supply. The ascending trend line from October remains intact. The measured target is $128, above all-time highs. The math is broken, the squeeze is here, the data proves it. Now I have one final question for you before I go. What time is it where you are watching this? And where are you watching from? I asked at the beginning, and I am asking again because I genuinely want to know. Drop your time and location in the comments. I read every single comment. And tell me, do you think the squeeze accelerates this week? Or do the shorts have more time? What price level are you watching? I will pin the best analysis. If you made it this far, you are part of a small group of people who actually want to understand what is happening in these markets. Most people will never see this data. Most people will never understand why the banks are flipping or why the delivery numbers matter or why the concentration data is so extreme. But you do now. Share this video with anyone who is sitting on the sideline wondering if silver is done. The data says it has not even started. The math says the system is on the edge of breaking. The charts say we are heading to $128. If you're not subscribed to Finance Currency, hit subscribe right now, hit the notification bell. I cover COMEX delivery data, CFTC positioning reports, short squeeze analysis, and everything happening in the precious metals market at a level nobody else is doing. This is Finance Currency. 81 million ounces left, 80 million ounces demanded. The math just broke, and the shorts are running out of time.